You are being tricked by the beauty of a monthly deposit. Every single month, right on schedule, your brokerage app lights up with a massive cash notification. 10%, 12%, thousands of dollars hitting your account on complete autopilot. It feels like the ultimate financial victory. But while you are celebrating those monthly dividend checks, Wall Street is quietly running a slow-motion execution on your life savings. You think you are beating the system, but the cold mathematical reality is that you are falling directly into the covered call trap. To understand why your covered call strategy is structurally designed to fail long-term, you have to understand the hidden contract you are signing. When you buy a covered call ETF like JEPI or JEPQ, or when you write individual options yourself, you are entering a toxic agreement. Wall Street says, "We will pay you a guaranteed immediate fee today." But in exchange, if the stock market skyrockets tomorrow, you do not get to participate in the wealth. You are legally selling your upside to institutional market makers for quick pocket change. You are putting a hard, concrete ceiling on your own compounding speed. This is where the game becomes completely rigged against the small retail investor. Covered call structures give you 100% of the downside exposure during a major market correction, but cap your recovery velocity when the market bounces back. When the S&P 500 crashes 20%, your covered call portfolio crashes right along with it. But when the economy recovers and rockets 30% higher, your fund stays completely flat because your upside was legally cut off at the ceiling. You take all the pain of the losses but receive none of the glory of the gains. Let's drop the theoretical arguments and look at the naked historical data. Look at the performance gap between a pure boring equity index like VOO and a high-yield option shield like JEPI over a sustained bull run between 2020 and 2026. While the standard index fund creates generational wealth by letting corporate monopolies grow naturally, the high-yield fund drains its own long-term compounding power to fund those monthly payouts. You are cannibalizing millions of dollars in future capital appreciation just to collect a short-term check that gets instantly taxed by the IRS at ordinary income rates. If you want an unkillable wealth machine, you have to stop chasing immediate yield and start maximizing total return. Big institutional money and smart domestic investors do not build their primary wealth foundations inside covered call parameters. They use these income funds strictly as late-stage retirement shields to pay current bills. During your wealth accumulation phase, your goal is to let your assets grow completely uncapped, without any options contracts slowing down your trajectory. Instead of letting your capital decay in covered call traps, these are the uncapped institutional engines you need to add to your watch list immediately. First, VOO, the absolute cornerstone for broad market exposure, giving you direct access to the 500 largest monopolies in the United States. Second, SCHD, the ultimate dividend growth shield that offers solid yield without selling off your future capital upside. And third, Q, for high-velocity tech and innovation exposure, capturing the absolute peak performance of global market leadership. Stop letting brokerage apps manipulate your investing psychology with high double-digit dividend flags. A 10% check means absolutely nothing if your underlying core stock price is permanently locked under a corporate glass ceiling. Shift your capital base out of the traps, uncap your growth velocity, and let real compounding take over. Review the systemic market volatility notice visible on your screen right now and in the description box below before executing any portfolio transfers. If you are ready to break free from Wall Street yield traps and build real, high-conviction wealth, smash that subscribe button right now. Stay disciplined, trust the naked math, and keep your hands off the portfolio.